One of the things that advisory services can include, this undefined advisory services, is helping your clients figure out whether they're performing well or not well, right? And how do you do that? You have to be able to measure certain metrics in the business. Otherwise, if you don't give yourself an objective way to look at the information, how are you ever going to know if they're effective, if they're growing? So I wanted to talk about key performance indicators, what they are, the different types, and then I created some examples of some KPIs for a tax firm. So I'm going to attempt to share my screen here. Let me make sure I can get this PowerPoint slide to do what I want it to do. I even took the time to make y'all a PowerPoint. Like, this is good stuff, right? Okay, so everyone should be able to see my key performance indicators screen, right? Thumbs up. Cool. Okay. Key performance indicators, what are they? Essentially, they are metrics that you can create that provide a quantifiable measure used to evaluate the success of an organization, an employee, a division, a department in meeting objectives for performance. That's the Oxford Dictionary explanation. What the heck does that even mean? So they provide a way for you to measure your progress toward a goal. They provide a way to compare performance between periods, between employees. Typically, key performance indicators can sometimes be stated as percentages, which makes things comparable, right? To say that one firm, you can have two firms that both want to grow 20%. Well, for one firm, that could mean adding $20,000 in revenue. And for the other firm, that could mean adding $50,000 in revenue. So if you only looked at dollars, firm B that added 50K is going to look more successful, right? They added more dollars, but in reality, they added the same 20%. So it gives you a way to make information comparable. And then KPIs can be high level, looking at the entire business as a whole, or they can be lower level where you drill down to employees, to divisions, to departments. And sometimes your client may need a combination of the two, depending on their size and their goals. So does that make sense to everybody so far? Yeah, cool. I like it. So I will be upfront and tell you guys that the majority of my clients, we've talked about this before. I work with a lot of what I call micro businesses. And for me, micro businesses are businesses that earn 500K in revenue and under. That is the majority of my clients. I do have a whole group of them that earn above that and some well above that. But the meat and potatoes, the bread and butter of my practice is tiny little businesses like mine. And that's where I specialize. Now, not all of those clients are in a position yet to either need advisory. I mean, everyone could use advisory, but they're not all in a position to afford advisory services. So I don't have a whole lot of clients for whom I'm developing regular KPIs. We may have an initial conversation like, hey, I want you monitoring this, or hey, I'm going to monitor these metrics for you. But we don't sit and go through this whole process. I'm going to show you guys in a couple of slides how to define a KPI to make it really good and really useful. So that's what KPIs are. There are a couple of different types. There are leading indicators and lagging indicators. Anyone want to take a guess what the difference is?
Leading's proactive and lagging is after the fact.
Right. So leading would be like tax planning. Lagging would be like tax preparation, if we're going to boil this down to a tax firm example. So leading indicators help the business owner define what they have to do to achieve their goal. So they know they want to grow 20%. Well, how do you do that? They're sometimes described as inputs, right? What do you have to do to get to where you're headed? It measures what needs to happen. An example for an accounting or a tax firm might be the number of clients who sign an accounting agreement. So if you got ahead of next tax season, if you got 50 clients to sign an engagement letter for taxes for the next tax season, that's a leading indicator because you have agreements, you know how many new clients you're going to have before tax season even gets here. So you can guess how much revenue that's going to generate and how close that puts you to your goal, right? Lagging indicators, like the example I use with tax preparation, report what already happened. So it measures current performance in production. sometimes described as outputs. For example, how much revenue was earned last month? That's a lagging indicator because it's reporting something that already took place. A leading indicator along those same lines would be how much revenue do we need to earn next month to hit our goal? So that's the difference between leading and lagging. Both are important. And if you're going to develop KPIs for your clients, you should have a good mix of both. You have to know where you're headed, and then you have to be able to compare where you're headed with where you actually are. Does that make sense to everybody? Any questions about the difference between leading and lagging? Yeah, cool. Okay. This, again, is my opinion. This is the proper way to define a KPI. Understand that depending on the scope of your agreement and the size of the company, you may not have to get super, super in depth with figuring these things out, right? If it's a smaller client, you can set just a couple, won't take you too long. You don't have to spend a whole lot of time. But if you're working with a larger client that has a lot more moving parts, or their goals are particularly aggressive, or for whatever reason, you may need to go through this whole process of learning their business better and learning them better. And this would help you do that. So you go through these questions. The first question, of course, is what is your desired outcome? That's going to be the goal you're trying to achieve. So in this example, I want to increase my tax season revenue by 20%. This is going to be for next year. Like, let's say in 2023 for tax year 2022. So I want to increase tax season revenue by 20%. Why does this matter? This is a conversation that I'll be having with my client. I'm not necessarily going to ask them. This is all going to be conversational, not just like a checklist. Why does it matter? Well, it matters because the business will become more profitable. Let them go on about why that's important to them. It helps you to get to know your person better. So then you have to think about, how are you going to measure progress? So I know my goal is a revenue goal. So I'm going to measure progress by tracking the increase in monthly revenue measured in dollars. So every month I want to know how many dollars of revenue did I earn? And then I can compare that with the prior period or the prior year. How can you influence the outcome? So how can you as the business owner influence the outcome? For me, I'm going to focus on, right? So I know to increase tax season revenue, I probably need to add some more clients. Maybe I need to increase my pricing, but I need to add more clients. So I'm going to focus on increasing my networking efforts, and I'm going to increase my marketing efforts. Either do more marketing, get more focused with my marketing, whatever it's going to be, but I need to attract new clients. So how am I going to influence it? I'm going to spend some effort on these areas. Then you have to figure out who's going to be responsible for the business outcome. Now, when you're working with smaller clients, like I do, the business owner is the responsible person. But if you're working with a little bit larger company, maybe you're a tax firm who has a salesperson or who has an operations manager, or if you have some layers, like if I had a salesperson and my goal is to increase sales, then my person responsible for this outcome is the salesperson. But in this case, we're going to say the business owner because we're in the small business wears many hats scenario for ease of this example. How will you know you've achieved your outcome? And this question is in here because some are a little bit easier to measure than others, right? If my goal is to increase revenue by 20%, that's pretty easy to figure out. How am I going to know I've achieved it? Because revenue will have increased by 20%. So that's pretty simple. And then how often will you review your progress toward the outcome? I'm going to review it on a monthly basis. So I know if my goal is to increase tax revenue by 20% next tax season, I'm going to look at gross revenue for January. Then I'm going to look at it again for February. I'm going to look at it again for March, and I'm going to look at it again for April. So I'm going to track it every month. Does that make sense to everybody? So as I was putting this together, because when I first started working with key performance indicators and business metrics with my clients, I felt really overwhelmed. And when I hear other people talking about advisory, I feel overwhelmed. I may have a little bit too much confidence. And even with all my confidence, I sometimes have imposter syndrome. And I think to myself, man, I can't do that. Like, I don't know how to do that. So when I was going through the process of developing these slides, and as I was teaching myself about KPIs and how to apply them in businesses, but especially when I was putting together this slide, it really made me realize it's not that hard. It really isn't. You take these, 7 questions, go over them with your client, and from that, you will be able to develop your key performance indicators. So don't get overwhelmed, break it down into steps, and then you'll be good to go. Any questions so far? We're like cruising right along. We're only 10 minutes into this meeting and we're already like almost done. Any questions about defining the KPI? Does anyone have anything they think should be added to this list? I'm just curious. If any of you go through this process with your clients, am I missing something? Darren, I'm sure you've got something.
Well, one index that I use is to kind of see, people always want to know if they're on track in their industry.
Mm-hmm.
And so in QuickBooks, I always use the percent of expense, expense percentages to income.
Okay.
So kind of no matter the size of the client, it's scalable as far as even if you're doing 100 grand or doing 500 grand in like real estate, your advertising should be, between 15 and 20% to your gross sales. And so that's one that I use a lot for clients.
Yeah. So benchmarking, when you're helping a client develop their KPIs, being able to use benchmarking can be really helpful, especially, if they're in growth mode and they want to know how they're doing compared with other companies in their same industry. You can develop their KPIs and then you can try to find some information from industry specific sources and you can benchmark their KPIs against industry. That can be really helpful too. So that's a good point. All right. So let's talk about some leading indicators for this imaginary tax firm that I've created. So we know we want to increase revenue 20%. We already put that out there. And I'm just going to say that it's 20% over last season's revenue. For this example, we're just going to talk about January through April, just to keep it simple. So some leading indicators would be to know before I head into tax season, how many tax returns I have to file to achieve a 20% increase in revenue. What amount am I going to increase tax prep fees by to achieve a 20% increase in revenue? Now, I'm not saying that you're going to use necessarily all of these in the same, I'm just giving you some examples of KPIs that are available related to that goal. So number of tax returns to file next season to achieve 20%. That's assuming maybe that you're not going to increase your fees at all, right? You're going to have a little bit of attrition. You're probably going to get some new clients, but at your current fee structure, how many tax returns do you need to file to achieve a 20% revenue growth? Let's say that you're planning to increase your tax prep fees. How much do you need to increase them by to achieve a 20% increase in revenue? A lot of people aren't going to necessarily increase their fees 20% from one year to the next. So it's not going to be that easy. Now, if you're like me, last year, I increased my base fee by 100%. So that was super helpful, but that's not sustainable for me. I totally have a typo here, but it's number of new clients to sign up by the end of 2022. So if I know how many tax returns I need to file, and I know how many I filed last season, how many new clients do I need to sign up? So those are all things that can help you to predict how your tax season is going to go and whether or not you'll be able to hit your 20% revenue goal. By comparison, lagging indicators. So now we're in tax season, right? I've got these goals for next year. Now it's January, February, March of 2023, and we're prepping returns for 2022. How many returns did I actually file during 2022, or in this case, 2023 for tax year 2022? How many returns were filed? How much did I increase tax prep fees? Was it 5%? Did I put a 10%? How many new clients did we file returns for this season? Right? So these are things that have already happened. Last year, I was predicting how many new clients I needed. Now I'm looking at how many new clients I actually signed up. And then the easiest way to track is looking at your actual gross revenue by month, right? How much was our gross revenue in January? How much was it in February? And I'm going to be checking that early the following month. So I'm going to be looking at January's revenue early in February so I can see how much I still have to do to be able, am I on track for that 20% increase? Did I increase 20% in January or not? Do I need to make it up in February, in March and April? So you can see some KPIs they're not super sophisticated, right? These aren't numbers that as tax professionals, it's hard for us to track. Generally speaking, our software can generate a report telling us how many tax returns we filed. Our accounting software or our tax prep software can tell us how much in fees we've charged, collected, or whatever during the tax season. So This is a pretty simple example, but I figured it'd be appropriate since we're all tax professionals here.